Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Chief Investment Officer at EMEA and Global Head of Equities, and we're going to discuss some of the key themes driving markets. These include concerns over US growth, the future for oil and other commodities, and the outlook for Europe. Mark, thanks for joining me today. Let's start with the US, where growth concerns continue amid mixed economic data and sentiment, plus the expected rate rise on the horizon. What's your outlook for the US?
Well, our outlook for the US is positive. We think growth will be in the sort of 2 to 2.5% region this year, but it's certainly less optimistic than other commentators in the market, and certainly less optimistic than the market found itself in the aftermath of Trump's election. When President Trump was elected, there was a lot of rhetoric about structural reforms, tax reforms, and deregulation. And as we know, equity markets and risk assets more broadly raced away at the expectation that growth would accelerate. And I think a degree of realism is now settling into markets, and growth expectations have been reined in. Now, on the one hand, growth is still coming through. And we saw from the most recent release that unemployment continues to fall, now down to 4.3%. So the labour market is, on the face of it, really tightening up. But we are yet to see that come through in terms of inflation, and other leading indicators are showing more mixed signals. Auto sales, for example, have been very weak, and other leading indicators have been rolling over. So we're in the sort of 2% range. So the US outlook looks okay, but it's certainly not reaching the heady heights that people were thinking about at the back end of last year.
But in Europe, following years of sluggish growth, corporate earnings are now on the up, while political risk appears to be diminishing. Have you become more positive on the region?
We have indeed, and we've been more positive on the outlook for Europe for a while. And I guess you can only keep an economy down for so long. At the end of the day, the cyclicality kicks in. As you say, certainly we've had the Dutch election and we've had the French election, so a degree of political stability is settling into the European market, and I think that is giving people more confidence. Many broad leading indicators are showing quite a significant upturn in economic activity, particularly in Germany and France, interestingly, but in other European markets as well. And we're certainly seeing that come through in terms of corporate profits, which are largely beating expectations. And the European economy looks to be in much, much better shape than it has done for many years. Valuations are relatively attractive versus other world markets, and again, particularly versus the US. So I think European equity market is well set for a decent run of outperformance.
Well, let's move to credit then, where valuations appear somewhat rich. Well, at some point, of course, we expect the ECB to begin to taper its programme of bond buying. What are your expectations for investment grade and high yield credit?
We're still favourably disposed there, as you say. A combination of an uptick in economic activity, favouring risk assets more broadly, plus the fact we've got the ECB buying bonds in the background, has been a very favourable backdrop for credit, which has performed extraordinarily well. The valuations look much less attractive than they did, although I wouldn't say they're necessarily expensive, but they're certainly less attractive than they were. But the economic fundamentals, we think, are still supportive of credit, both high yield and investment grade. So I think we'll stick with our positions for now, but we need to watch this space carefully. And if valuations tighten materially from here, then maybe that's something we would look to reconsider.
The oil price remains under pressure at the moment, and the commodity sector continues to be weak. Which assets and regions does this most suit going forward?
One of the things that we saw last year, and coming back to the conversation we were just having about the outlook for US growth, so as the growth outlook seemed to improve last year, we saw many cyclical and industrial parts of the market perform very well, and certainly commodity prices rallied, and the commodity sectors more broadly rallied very sharply, and this led to a strong outperformance by the value area of the market and an underperformance of the growth area of the market. And we've seen to some extent that reverse as commodity prices have flattened off, as the growth expectations have weakened and the outlook has softened. Certainly the value areas of the market have certainly come under some pressure, and growth, which is again increasingly seen as a scarce resource, has come back into the spotlight. So we've seen that reversal come through this year, and growth areas of the market perform much better.
Okay, well, with regard to equity markets and the style shift that you've spoken about, do we see that staying the case, or will we see the rotation go back again?
I wouldn't say so. We think that given that, as I said, the degree of realism that's settling in terms of the outlook for global growth, means I think that companies that can genuinely grow both their top line and their profits will be favoured by the market, and that's certainly where we're mostly overweight.
Mark, thanks very much.